If you do not find a way to make money while you sleep, you will work until you die. You have probably heard this famous quote by Warren Buffett 100 times. It is plastered all over social media, usually accompanying a video of someone trying to sell you a dropshipping course, a cryptocurrency trading bot, or some secret formula to get rich in 30 days. But let us be absolutely clear from the very beginning, that is precisely the opposite of what Warren Buffett meant, and it is exactly what this message is not about. Today, we are looking at the cold, hard mathematics of wealth. We are going to examine why trading your time for a paycheck is a mathematical trap designed to keep the average American exactly where they are, and how the wealthiest investors in history have systematically detached their physical labor from their financial growth. To understand how to break free from the wage trap, we first have to understand the trap itself. The 40-hour work week was not handed down by nature. It was popularized in the early 20th century by industrialists like Henry Ford. It was designed for an era of factory assembly lines where a worker's physical presence was directly tied to the factory's output. You stood at the line for 8 hours, you pulled the lever, you produced a certain number of parts, and you were compensated for those 8 hours of physical exertion. But we no longer live in an industrial economy. We live in a digital, capital-driven economy. Yet, the vast majority of the population is still operating on the Henry Ford model, exchanging 1 hour of their most precious, non-renewable resource, their time, for a fixed amount of fiat currency. The fundamental flaw in this system is the ceiling it places on your potential. There are only 24 hours in a day. Even if you are a highly educated professional, a surgeon, a corporate lawyer, or a specialized engineer billing $500 an hour, your income has a hard, impenetrable cap. The moment you stop operating, litigating, or coding, your cash flow instantly drops to zero. You are entirely dependent on your own physical and mental endurance. If you get sick, if you burn out, or if you simply want to spend a month with your family, the money stops. This is the definition of active income. It is a linear equation in a world where real wealth grows exponentially. If your only source of income requires you to be physically present, you're running on a treadmill that never stops, and the speed of that treadmill is constantly increasing due to forces entirely outside of your control. To understand the mindset required to step off this treadmill, we have to travel back to Washington, D.C. in 1946. Warren Buffett was just 17 years old. He was not a billionaire. He was just a high school teenager looking for a way to make a few extra bucks. He and a friend bought a dilapidated, used pinball machine for $25. They fixed it up and convinced a local barber to let them place it in the back of his shop, offering to split the profits. On the very first day, the machine collected $4 in nickels. Within a single week, it had entirely paid for itself. But here is the critical detail, the exact moment that separates the working-class mindset from the wealthy mindset. When the average person makes a quick profit, their immediate instinct is to improve their lifestyle. They buy better clothes, go to a nice restaurant, or upgrade their car. Buffett did none of that. He did not take that $25 profit and spend it. He did not even save it in a bank account to gather dust. He used that exact profit to buy a second machine, and he placed it in another barber shop across town. A few weeks later, he bought a third. Soon, he had a small empire of pinball machines spread across the city. Think deeply about the mechanics of what a 17-year-old Warren Buffett actually achieved here. He was sitting in his high school classroom, studying history or mathematics, while across town, 3 machines were collecting nickels on his behalf. He was sleeping in his bed at night while his assets were ready and waiting for the next customer the moment the barbershops opened. He had officially detached his income from his physical time. He was no longer working for the money. His capital was working for him. This is the foundational secret to building wealth. It is not about working harder. It is about building or acquiring systems that work relentlessly in the background, 24 hours a day, 7 days a week, without asking for a raise, taking sick days, or needing sleep. To see why the standard path, getting a good degree, landing a salaried job, and working 40 hours a week for 40 years keeps you mathematically stuck, we need to view your personal finances through the lens of a corporate income statement. In a business, you have top-line revenue. From that revenue, you deduct the cost of goods sold and operating expenses. Whatever is left at the very bottom is your net income, or profit. When you trade time for money, your top-line revenue is your gross salary. If you make $100,000 a year, that is your top line. But before you even see a single dime of that money, the government takes its cut. In the United States, a W-2 wage earner is the highest taxed entity in the entire tax code. The system is fundamentally designed to tax labor heavily while providing massive tax advantages to capital and business owners. After federal taxes, state taxes, Social Security, and Medicare are siphoned off, your $100,000 is immediately reduced to perhaps $70,000. Then, you have to pay your operating expenses. These are the costs required just to keep you alive and able to return to work the next day. Your mortgage or rent, groceries, car payments, gasoline, health insurance, and utilities. By the time you reach your personal net income, the money left over at the end of the month, there is very little left. And for the vast majority of Americans, that tiny sliver of net income is then used to buy liabilities, consumer goods, vacations on credit, or a slightly newer car that depreciates in value the moment it is driven off the lot. Meanwhile, the wealthy operate on a completely different set of rules. They do not focus on increasing their W-2 salary because they know that higher salaries just mean higher tax brackets. Instead, they focus on acquiring assets. An asset is simply a financial vehicle that puts money into your pocket without requiring your daily physical labor. A liability is something that takes money out of your pocket. The working class buys liabilities disguised as assets, like a primary residence that requires constant maintenance and property taxes, or a luxury vehicle. The wealthy buy true assets, cash-flowing real estate, equity in businesses, and stocks. Furthermore, the income generated by these assets, capital gains and dividends, is taxed at a significantly lower rate than the wages you earn through your physical labor. The rules of the game are written to reward those who allocate capital, not those who sell their time. Even if you manage to save a portion of your income, you face another massive hurdle: inflation. You might be thinking that investing is risky and that you will just keep your money safe in a high-yield savings account. This is perhaps the biggest financial illusion of our time. Warren Buffett has repeatedly stated that cash is the worst investment you can possibly hold over a long period. Why? Because fiat currency is designed to lose value. Let us look at the math. If inflation is running at an average of 3 to 4% a year, and your bank pays you 1 or 2% in interest, you are mathematically losing purchasing power every single year. Keeping your money in cash is not playing it safe. It is choosing a guaranteed, slow bleed. It is a tax on the financially uneducated. The $100 you hide under your mattress today will simply not buy the same amount of groceries, gas, or housing a decade from now. We see this through shrinkflation at the grocery store and the rapidly escaping dream of homeownership for the younger generation. Wages rarely keep pace with the true cost of living. To stop trading time for money, you must protect the money you have already traded your life energy to earn from evaporating into thin air. You must convert depreciating fiat currency into appreciating, productive assets. You're essentially exchanging melting ice cubes for solid gold. This transition does not happen overnight. It requires immense discipline. It requires taking the true net income from your personal income statement, the gap between what you earn and what you spend, and ruthlessly redirecting it into assets that yield compounding returns. This brings us to the core of Warren Buffett's investment strategy, a strategy he has consistently recommended for 99% of everyday people. When the average person hears the words stock market, they instantly think of gambling. They picture day traders staring at 6 glowing monitors, sweating over red and green candlestick charts, trying to time the market, or risking their life savings on highly speculative options contracts. Buffett calls this a fool's errand. Real wealth is not built by frantically trading. It is built by patiently owning. Buffett's ultimate advice is remarkably boring, which is exactly why it works. Buy a low-cost S&P 500 index fund, consistently add to it, and hold it forever. When you buy a share of an S&P 500 index fund, through tickers like VOO or SPY, you are not buying a lottery ticket. You are acquiring a fractional ownership stake in the 500 largest, most profitable, and most powerful companies in the United States. You are instantly diversifying your money across technology, healthcare, financials, consumer goods, and energy. Shift your perspective for a second and think about what this actually means. When you own the S&P 500, you have Tim Cook at Apple, Satya Nadella at Microsoft, and hundreds of other world-class CEOs going to work every single day on your behalf. You have roughly 30 million employees across these 500 companies waking up early, commuting in traffic, innovating new products, writing code, and pushing sales, all to increase your net worth. You do not have to manage them. You do not have to pay their health insurance, handle their human resources complaints, or sit in their exhausting board meetings. You simply deploy your capital and their time, their labor, and their brilliance work for you. You have successfully reversed the equation. Instead of selling your time to a corporation, you are using your money to buy the output of the entire global economy. The S&P 500 is also a self-cleansing mechanism. If a company inside the top 500 starts to fail, if its management makes terrible decisions, or if its products become obsolete, its market cap shrinks. Eventually, it is kicked out of the index entirely, and it is automatically replaced by a newer, faster-growing, more innovative company. You do not have to read financial statements to figure out which company is dying and which is rising. The index does the weeding for you. Many people believe they need to hire expensive financial advisors or hedge fund managers to build wealth. The financial industry spends billions of dollars on marketing to convince you that investing is too complex for you to handle on your own, and that you must pay them a 2% management fee to handle it for you. Warren Buffett despised this predatory fee structure so much that in 2007, he issued a public challenge. He bet $1 million that a standard, unmanaged, low-cost S&P 500 index fund would outperform a hand-picked portfolio of elite hedge funds over a 10-year period. Protege Partners, a wealth management firm, accepted the bet. They selected 5 fund of funds, effectively combining the brainpower of hundreds of the highest-paid Wall Street analysts, backed by supercomputers and insider industry knowledge. The 10-year period included the devastating 2008 financial crisis, making it a true test of resilience. By the end of 2017, the results were in. The elite hedge funds, after taking their exorbitant fees, delivered an average return of 22% over the decade. Buffett's boring, unmanaged S&P 500 index fund delivered a staggering return of 125%. Buffett won the $1 million and donated it to charity. The lesson here is profound. You do not need to be a financial genius to build wealth. You just need to capture the broad growth of the American economy and avoid paying Wall Street middlemen to eat your profits. The mechanism that makes this strategy unstoppable is compound interest, which Albert Einstein reportedly called the eighth wonder of the world. Compound interest is simply earning interest on your interest. Imagine you roll a small snowball at the top of a long, snow-covered hill. As you push it down, it picks up a little bit of snow, but as it gets bigger, its surface area increases, allowing it to pick up even more snow at a faster rate. By the time it reaches the bottom of the hill, it is a massive, unstoppable boulder. That is what happens to your money. If you start investing $500 a month into the S&P 500 at age 25, assuming an historical average return of around 8 to 10%, you will have accumulated over $1.5 million by the time you retire at 65. But here is the most astonishing part of that math. Out of that $1.5 million, only $240,000 was actually money you contributed. The remaining $1.2 million is pure compounded growth. It is money that grew out of thin air because your capital was breeding more capital. Buffett's own wealth trajectory is the ultimate testament to this phenomenon. While he is celebrated as a billionaire today, the vast majority of people do not realize that over 90% of Warren Buffett's wealth was accumulated after his 65th birthday. His wealth did not explode because he made a few lucky trades in his 20s. It exploded because he consistently allocated capital into productive assets and allowed the mathematical magic of compound interest to work undisturbed over 7 decades. If the math is so simple, why doesn't everyone do it? Why do so many people lose money in the stock market? The answer lies in human psychology. It is entirely emotional. To stop trading time for money, you must develop an iron stomach. The stock market is highly volatile in the short term. Over a 30-year investing horizon, you are guaranteed to experience multiple severe recessions. You will see your portfolio drop by 20, 30, or even 40%. The media will panic. News anchors will declare that the economy is collapsing, that this time is different, and that you need to sell everything and buy gold. This is the exact moment when the transfer of wealth happens. When the market crashes, the amateur investor panics and sells their assets at a massive loss, trading their ownership back into depreciating cash out of fear. The wealthy, however, view a market crash as a clearance sale. Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." When the stock market drops by 30%, it does not mean that Apple stopped selling iPhones, or that Microsoft stopped selling software, or that people stopped drinking Coca-Cola. It just means that the temporary, emotional price tag attached to those companies has gone down. A true capital allocator does not panic during a recession. They buy more assets at a steep discount, knowing that the broad market has historically always recovered and reached new all-time highs. Your success in detaching your time from your money is not dependent on your IQ. It is entirely dependent on your emotional discipline, your ability to sit on your hands and do absolutely nothing when the rest of the world is losing its mind. While investing in index funds is the most reliable path for the money you have already earned, you also need to apply Buffett's principles to how you earn your money in the first place. Buffett loves businesses with an economic moat, a unique competitive advantage that protects a company's profits from competitors. Think of Apple's brand loyalty or Google's monopoly on search. You must build a personal economic moat. If your job can be easily learned by someone else in a week, or if it can be automated by artificial intelligence, you have no moat. You are highly replaceable. which means your time will always be valued at a low price. To increase the amount of capital you have available to invest, you need to develop high-income, specialized skills. But more importantly, you need to transition those skills from a time-based model to a scalable model. If you are a graphic designer charging an hourly rate, you are trading time for money. If you create a digital course teaching graphic design, or if you build an agency where you hire other designers and manage the client relationships, you have built a system. You create the course once, but it can be sold 1,000 times while you sleep. You negotiate the agency contract once, but your team executes the labor while you capture the margin. You have built a pinball machine. Ultimately, this entire philosophy requires a fundamental shift in how you define wealth. Society conditions us to believe that wealth is visible. We are trained to look at the guy driving a financed Ferrari, wearing a flashy watch, and living in a massive house on a 30-year mortgage and think, that guy is rich. But true wealth is almost always invisible. Wealth is the money that is not spent. Wealth is the portfolio of index funds quietly compounding in a brokerage account. Wealth is the cash-flowing duplex across town. Most importantly, wealth is having control over your calendar. The ultimate goal of money is not to buy luxury goods to impress people you do not even like. The ultimate goal of money is to buy back your time. It is the ability to wake up on a Tuesday morning and decide exactly what you want to do with your day. It is the freedom to walk away from a toxic boss, to spend a month traveling with your family, or to pursue a passion project that pays nothing simply because you want to. So, the question you have to ask yourself tonight is not just, how can I get a raise at work? The real question is, how many more hours of my life am I willing to sell before I decide to let my money do the working instead? You do not need millions of dollars to start. You do not need a Wall Street background, a trust fund, or a genius-level intellect. You just need to make the conscious decision to stop being a consumer and start being an owner. You need to buy your first pinball machine, whether that is your first share of an S&P 500 index fund, your first piece of real estate, or your first scalable side business. You need to ruthlessly guard your net income, live below your means, and deploy your capital into productive assets. The clock is ticking. Every day you wait is a day of compounding growth lost forever. Your time is finite, fragile, and far too valuable to sell for a fraction of what it is worth. Build your systems, allocate your capital, and let the mathematics of wealth work for you, so that one day you can finally stop working for your money and let your money work for you.